Hey, what's up? Welcome back to Dapper Dividends. I am Russ, and today we're going to look at two very well-known famous companies, Hershey's and Nestle, and we're going to see which one we're going to get on the fence and figure out what company is the better choice for long-term dividend growth investing. But before I get to that, I'm going to tell you how you can buy the dip each and every time. But before we get to that, I would encourage you to very casually walk, don't run, and click the like button. Really helps me out. Thank you very much in advance. Now, how to buy the dip each and every time. It's so simple. Keep putting money in every single week or month. However you do it, keep dollar cost averaging in. It's so simple to do. You will never miss the dip because we know when it's a dip after it's already dipped and it's already on its way up and it's been confirmed that it's been a dip. You're trying to time the market. Many people, they buy when it's on the way back up off the dip. Just keep putting money in is what I do. Consistently dollar cost averaging that money in every single week. I put money into the market and I'm buying every single week. That's how you can buy the dip. Every single time, guaranteed. You will never miss out on a dip. With that being said, let's take a look at what the better dividend growth company is, Hershey's or Nestle's. Actually, I want you to pause the video right now and in the comments, put down products that you think that Nestle owns, because honestly, doing this research, I was really surprised to find out just how expansive the Nestle empire is. I'd love to know. Don't go any further. If you work for the company or if you've watched some kind of documentary or done research on Nestle, you're going to ruin it. You're disqualified. I want you to type out and list some products that you know or you think you know that Nestle makes. All right, the Hershey Company was founded in 1894 and is headquartered in Hershey, Pennsylvania. Has a market cap of $32 billion and employs 21,000 people worldwide. The Hershey Company, ticker symbol HSY, was founded in 1894 by Milton S. Hershey and is a global confectionary leader known for producing, distributing, and marketing chocolate, sweets, mints, gum, and other snacks under more than 80 brand names in approximately 85 countries worldwide. Some of Hershey's major brands include Hershey's, Hershey's Kisses, Reese's Twizzlers, Skinny Pop, and Pirate's Booty. Morningstar gives Hershey Company a 2-star rating with a $133 fair value estimate. CFRA Analyst Report gives Hershey a 3-star hold rating with a 12-month price target of $149. Averaging the two targets together gives us $141, making this about 8.5% undervalued. Nestle is the largest food and beverage manufacturer in the world by sales and traces its history back to 1866 and has a market cap of $333 billion and has 291,000 full-time employees. Nestle generates more than $90 billion in Swiss francs in annual revenue with a product portfolio including brands such as Nestle, Nescafé, Perrier, Pure Life, and Purina. Nestle also owns just over 23% of French cosmetics firm L'Oreal. The company has a vast portfolio of global products with 34 brands, each achieving more than $1 billion of Swiss francs in sales annually and a geographic presence that spans 189 countries. Morningstar gives Nestle a 2-star rating with a fair value estimate of $103. Schwab gives a B buy rating, but they do not give a price target, so I went to Yahoo and found that their average analyst target is $138, which we average these two together, gives us $120.50, or making this about 3.25% undervalued currently. Keep in mind that $1 equals 0.913 Swiss francs. They have a $305 billion Swiss franc market cap, which makes it $334.7 billion US dollar. Hershey is currently $154. And Nestle is $116.69. Hershey's 1-year return is 5.7% as opposed to Nestle's 10.8%. And if you look at the shareholder returns over the last 5 years, Hershey comes in at an astounding 105%, while Nestle is only at 78.2%, underperforming the market of 90.5%, while Hershey solidly beat the 90.5% of the market. The Hershey PE is 26.89. Now the 5-year average is 28.52, so when I divide the current into the 5-year average, I get a valuation of almost 6% undervalued. And with Nestle having a PE of 22.61, their 5-year average is 28.511, very similar to Hershey's. I find them at almost 20% undervalued. I give the edge on this one to Nestle. Simply Wall Street currently has them both overvalued in the mid-teens, so this is about even. Future growth, which is based on analyst estimates, this one goes to Hershey's at 5.7% as opposed to Nestle's 3.8%. 17% historical annual earnings growth for Hershey's as opposed to 3.2% for Nestle. Hershey's gets the big edge here. Profit margins are about the same, 14.9% for Hershey's as opposed to 15.3% for Nestle's. If we look at the return on equity, so return on equity, if you didn't know, is defined as the amount of profit a company earns per investment dollar. So basically how much profit a company earns with the money shareholders have invested. So for Nestle, for every dollar invested, 30 cents of profit is earned, which is really, really nice. You usually want to see return on equity in the teens. This is great. But as you see here, return on equity also increases with high levels of debt, especially when they're used for share repurchases. Hershey has suspended their share repurchases, but this has boosted and kind of skewed as Simply Wall Street caught their return on equity. Debt to equity, Nestle does have the better debt to equity ratio, but I'm more concerned with the interest coverage ratio, the ICR. And as you can see here, the ICR tells us how many dollars of operating income can cover every dollar of interest expense. Hershey has $16.07 of operating income to cover every $1 of interest expense, while Nestle is at $13.38. A lot of investors traditionally look for something that's over 5. 5 is kind of the minimum, so there's really no issues here. So the dividend is paid by both, 2.09% for Hershey versus 2.55% for Nestle. As you can see, Hershey's next ex-dividend date is November 18th. So you got to buy by the 17th to qualify for the payment that's going to be made on December 14th. Dividend yield versus the market. They are both underperforming the market and the industry average, although Nestle is just a little bit under the industry average. Current payout to shareholders. This is something I want to touch on. This is using earnings per share, GAAP earnings per share, which can be more massaged and manipulated by finance and by the accountants. So what I like to use is the free cash flow ratio. This is more of a true number to tell you exactly how much they're paying out as a dividend if they can sustain that. So 55% for Hershey and 58% for Nestle. Now check out how Market Beat shows a 38% payout ratio, but I like to use the trailing 12 months and the cash flow statement. And when I do, I get about 42.5% when you divide the cash dividends paid into the free cash flow. Honestly, anything under 70% is good. And obviously, the lower, the safer, and more potential there is to grow and sustain that dividend. Nestle is a bit harder to track down because they're OTC, their pink sheet, which I'll explain in a minute. I used Guru Focus for the free cash per share and the Citibank ADR statement. When I use those two numbers, I come with a cash flow payout ratio of 66.8%, getting close to that 70% red flag threshold area that I have. They're both paying a growing dividend of at least 10 years with Hershey's dating back 30 years of payouts. And here you can see it looks like Nestle has been paying a dividend since 1959. Both cover their dividend, but Hershey's has had a 5-year growth rate of 7.70%, only compared to 2.50% for Nestle. So given the lower free cash flow payout and the higher growth rate, I definitely got to give the edge to Hershey's. One more important thing to know is that Nestle is an ADR, which is an American Depository Receipt, and it is a negotiable certificate issued by a U.S. depository bank. In this case, theirs is Citibank, which represents a specified number of shares, often one share of a foreign company's stock. The ADR trades on the U.S. stock markets as any other domestic shares would, and they offer U.S. investors a way to purchase stock in overseas companies that would not be available otherwise. So foreign firms also benefit as ADRs enable them to attract American investors and capital without the hassle and expense of listing on the U.S. stock exchanges. So the ADR really is a receipt, and it's different from an ADS, which is the actual share. The ratio here is 1-to-1, meaning that each receipt represents one share, where some companies, because of a low share price, if they want to trade and be attractive and not look like they're going bankrupt, you could get 100 or 200 shares for every single ADR receipt, and that will be listed in the ratio on the financial documents. So there are pass-through fees that are going to go to Citibank because they are the depository bank that performs the roles of, they wear many hats. They're the registrar, the transfer agent, they keep the records, and they are also the dividend paying agent. So the ordinary X date, pay attention, was April 27th, 2020. The ADR payable date was June 5th. The ordinary rate was $2.70. This is always a concern with the foreign exchange, the FX conversion rate. The conversion rate when this was filed was 97 cents to every $1 US. So your dollar was stronger, but if the dollar was weaker, then you're going to get a lower dividend payout. The gross rate was $2.76, but they have the tax rate of 15%. They're withholding 41.5 cents, and they also hold 2 cents of the cash dividend fee, and the tax relief fee is 0.5 cent. So your dividend drops all the way down to $2.32, rounded up, call it $2.33. This is just one more thing to pay attention to whenever you see ADR. And then if you look in the notes, they're going to explain everything as I showed here. They have the tax relief source fee of 0.005 cents, and that'll be applied to ADR shares held by individual U.S. residents that receive the 15% reduced withholding tax. And here's one last thing that they point out. The depositary has no obligation to obtain the most favorable exchange rate, makes no representation that the exchange rate is at a favorable rate, and expressly disclaims liability for any direct or indirect losses associated with the exchange rate. So when you hold this, you're unwittingly or unknowingly, you're exposed to the Forex currency market, and depending on when the dividend needs to hit, if something happens or changes between currency and there's volatility, you're going to get stuck with that, and you may get a lower dividend payout. All in all, what does this mean? This basically means that 16% of the dividend was eaten up by processing fees and the ADR pass-through fees. Again, with the ADR, you're hit with 3 fees that you don't have to worry about if you're going with a company like Hershey or a company that's traded on the stock exchange that is not an ADR or is OTC. And if you are receiving these in a taxable account, tax advantage account, you're a little bit ahead. You're only going to pay the qualified income tax rate as dictated by the Internal Revenue Service. Time to get off the fence. I was so surprised at how many products Nestle owns and how much of a presence around the world that they have. 189 countries making products that people need to live on. Hershey's is great. They have some baking ingredients, but they don't have the food staples like baby food, pet food. Nestle really does run the gamut of everything that we need to live. That's the reason they are the 13th largest company by market cap in the world. They are so diverse, and they have their tentacles everywhere throughout the food and confectionery industry. So this one is really tough. Last week, I did Yum Brands, ticker symbol YUM, and Restaurant Brands International, ticker symbol QSR. I didn't like either of them. I didn't get a good feeling about either, and I wouldn't have bought either of them. This week is much more difficult in the other direction because I really like both of them. I don't own either of them, full disclosure, as of the recording of this video, and I really would like to own both of them, but I can't choose both. So my dividend growth investor heart says to go with Nestle, but my dividend growth investor head is telling me Hershey. So in this case, I'm really not that thrilled. I don't like the ADR pass-throughs. I own Neo, which is an ADR as well. And when they came due, even though they don't have a dividend, I still had to pay that ADR pass-through rate. Now that does eat into the dividend a little bit, as I showed you earlier in the video. And just weighing out the two of those, I'm going to go with Hershey's just because they have a lower free cash flow payout ratio. They've been growing the dividend at a higher rate than Nestle has. They've been growing it at just over 7% compared to just over 2% over the last 5 years compared to Nestle. But honestly, if you wanted exposure to a truly international company, I would not hesitate to go with Nestle. 189 countries they have their products in. You can't get much more diversified internationally than that. And having to deal with the currency exchange rate volatility, the ADR pass-through rate, it really wouldn't matter to me. They're so big, they're so solid, they have so much cash flow coming in. I would, and I may actually become an investor into Nestle's. I'll let you all know that. But as it stands right now, I'm going to pick Hershey's. Just, it's a little bit safer and a little bit of a higher paying out yield that the dividend is at. So with that being said, Hershey's is my choice this week, but Nestle is a super close second, and I would really be okay investing into either. And with that being said, please do me a favor, like and subscribe if you got value from this video. I would also encourage you to check me out on Twitter. Hit me up at RustyRams78. I'm there every day, tweeting away, chatting, engaging with all y'all fine folks out there. And please go to my website, dapperdividends.com. We have some articles, and it's been a little bit mothballed, but it's still there. And I have a podcast called Dapper Dividends as well. You can find it on all your major podcatching platforms. I do that twice a week, every Tuesday and Friday, God willing, that I can keep on doing it. I'm going to keep doing it. And as a friendly disclaimer, as my main man, Ian Lopik, says, I am not a licensed financial advisor, and this is not financial advice. If you do want advice on your investments, you need to seek a licensed fiduciary, of which I am not, because these are just my thoughts and opinions shared for fun and entertainment. And with that being said, check out one of my videos that I just recently did. Check out the QSR and Yum Brands video. Let me know what you think. As always, expertise comes from the community, and I really would like to hear what you have to say. Engage, talk, give me your opinion if you would invest in either of these, and I hope you really did leave a comment and tell me what brands or products you think that Nestle owned or was responsible for. I love you guys. I'll be back next week. Peace.